Hi everyone, we're about halfway through the year, so it's time for a little jobs checkup. So far this year, job creation has been a bit volatile. We've seen it bouncing around on a month-to-month basis, but for the first 6 months of 2019, we've added just over 1 million jobs. That's a little bit slower than what we've seen over the last few years. In fact, that's the slowest first half since 2010, but it really reflects the very low unemployment rate, which is 3.7%. As I've mentioned in previous videos, there is a labor shortage. We still have 1.3 million more job openings than we have people looking for work. So that's part of what's driving that slowdown in job creation, is that we just don't have enough people to fill the open positions. We're in one of the longest expansions on record. And as of the end of September, when that quarter ends, we'll hit the 10-year mark, matching the growth cycle from the 1990s. We've added jobs continuously every month for 105 months, and that's the longest streak ever. We've added 21.6 million jobs this expansion cycle, and that's second only to the 1990s expansion when we added 24.6 million jobs. So what could go wrong? The pace of job creation is slowing a little bit, and that brings up one of the warning signs that economists are monitoring. A signal of an impending recession that economists watch is when there's a surge in the unemployment rate. All of the last 10 recessions have been preceded by a surge in unemployment of at least 25 basis points in a 3-month span. So with job creation slowing, are we at risk of seeing something like this? Well, this hasn't happened, and as long as we continue to add an average of at least 100,000 jobs per month, we should be good. At this point, the economic and jobs outlook is still sound. And this strong employment market is supporting all types of commercial real estate. Preliminary numbers for apartments are just coming in, but we have second quarter vacancy falling to about 4.2%. That's the tightest second quarter vacancy rate in 19 years, and it's particularly significant considering the wave of development that we've been seeing. We've been adding 300,000 new apartments per year for the last 4 years. The second quarter numbers aren't in yet for the other property types, but right now we're expecting additional tightening in vacancy rates for retail, office, and industrial properties. For investors, the short-term horizon looks very good, both economically and from a space demand standpoint. Over the longer term, the outlook gets a bit shakier. We do have the trade war out there, but the current détente in trade relations with China could lead to stabilization. The big thing to watch, though, is the Fed. They're meeting next week, and if we see a rate reduction, we could see a downward pressure on the 3-month Treasury rate, and that in turn could uninvert the yield curve. That alone could give this cycle longer legs. Although this cycle is long in the tooth, with a 10-year cycle, that's very long, it still has potential to run. Certainly there's some risks out there, but underlying demand drivers for all types of commercial real estate are strong, and overall the investment outlook is positive. But a rate cut by the Fed next week has the potential to extend the runway.